All right. Just everyone take a look at the disclaimer one more time. All right.
Yep.
You can share your screen, Dean.
Let me share my screen here. And let's take a look at our single leg dashboard report. We've covered it a couple times, but we'll take a look at it again. Let me close this to expand the page. And on this page, what we're doing is looking at the options trades and then taking the single leg trades, a call or a put option that doesn't have a multi-leg or contingent trade attached to it. So these trades themselves are a result of a single leg order. Okay. And you could see here that there were 7.4 million contracts that traded that were single leg out of a total of 9.2 million. And then what we do is take those trades and we analyze them from different perspectives to get some insights. How traders were utilizing option contracts, single leg option contracts. And then we look at it from a couple different perspectives. So let's just take a look at it here. There were 60% of those trades were calls, 40% puts. Then we look at the interpretation. How were those orders coming in from the end users? So, were the end users trying to take liquidity more, or were they providing liquidity? And which direction were they going in? Were they more trying to take it from the buy side or hit it from the sell side? Okay. So from our interpretation, 48% of the incoming orders look like coming in from the buy side. 51% of them look like they were coming in from the sell side. Okay, so pretty much even. Buys versus sells. Then over here, we have the most active options. These are single leg options. These are the most active. The 5 top ones with the total volume and the VWAP price. So these would exclude any type of spreads or contingent trades involved in this option. So you can see here the June 21st 130 call. That was this is from Friday, so this would have been Friday's expiring option. Traded 404,365 contracts, and for a VWAP price of 58 cents. And this is a hyperlink, so if we click on it, it will take us to the options chain, and then we could analyze this further, look at the time in sales, look at how it traded throughout the day and so forth. But this just gives us a quick idea what are the most popular traded options as far as single leg options transactions. And here, if we just kind of scan with our eyes and want to look for a pattern, we could see here all of them were the 0DT. Those were the options that expired same day, June 21st. And then we could kind of tell that it was a mix calls, puts, and they all look like, let me see, I'm just eyeballing it here, but probably around that at the money at the time of the trades. Looks like, if we just look at the strike ranges from 125, between 125 and 130, that looks like where the same range the stock traded in. Okay. Then moving on, we have another analysis, and we convert that volume. So we could take all this volume, and then we could convert that volume based on its Greeks, the delta, the gamma, the vega, theta, to get an idea if there's a big lean one way or the other, the way the order flow was coming in. Again, this is an interpretation based on the rules that we set. So here on balance, the way we interpreted that there were a negative 3 million deltas on balance traded in Nvidia. In other words, if we looked at, incoming buying puts would be negative delta, incoming selling calls would be a negative delta, incoming buying calls would be positive, and so forth. So if we took it on balance, it looks like there was a negative 3 million deltas coming in from options. What about the gamma? So the gamma looks like negative 8 million. And what that suggests is that there's more selling of options than buying that have a bigger gamma. So the options that are expiring, the options that expire closer to expiration have a bigger gamma. Okay, they always have a bigger gamma because right up at expiration, they go to parity, right? So right at the closer you are to expiration, the closer you are, the bigger your gamma is in the options, especially like the at the monies or around the at the monies. And this would make sense from what we're seeing because the top 5 options were all expiring the same day. So these would have a really big gamma, especially once they're around at the money. And it looks like probably more selling of those options than buying. So on balance, we see a negative 8 million gamma. All right. What about the vega? So the vega it's the option sensitivity to implied volatility. And the further you go out, the larger your vega. Because think of it, when an option expires, it has no implied volatility, right? It'll be parity. There's no more sensitivity to implied vol because it's either worthless or it's worth whatever its intrinsic value is. But the further you go out, the more time premium you have. And the further you go out, the more sensitive an option is to a change in implied volatility. It will just have a bigger vega. So the vega could kind of tell us on balance if there's not only, so the gamma is showing us there's more selling of options relative to gamma, but that could all be on the short end of the term structure. The vega kind of tells us on balance how the implied volatility, right? Where are people on balance selling more implied vol or vega? And this shows us that there's a negative 114,000 selling a vega. Okay, negative 114,000. And then we have the theta. So whatever, it would be, if you have negative gamma, you'll have a positive theta. Positive gamma, you'll have a negative theta. All right, so positive gamma means you're net long options, and if you're net long options, you have decay. That would be negative theta. If you're net short options, you have a positive decay, right? Your time decay is working for you, so you'd have a positive theta. Okay. So let's move on then to the conditions. Okay, when we enter in single leg orders, how were these orders executed? Okay, so these are telling us the way that the distribution of how these orders were executed. So 70% of them were auto executed. So they were executed electronically by the exchange's matching engine. Meaning buyer and seller were matched up. We're just matched up at a whatever price. Then we have 22% were hit the price improvement auction. So the price improvement auction, and most exchanges have it, works the following. When you enter in an order, let's say an end user enters in an order to buy or sell an option, and it could be marketable, right? So let's say that the option is $1 bid, $1.10 offer, and you enter an order, I'll buy it at $1.10, right? Whatever price you see, you'll buy it at $1.10. Well, the exchange can, before it gets executed, could flash that order, let's say for 1 second, to its market makers and specialists. And what it does is it asks, would anybody, we have an order to buy for 110, is anybody willing to give it a better price, like 109 or 108? So it creates a competition really quickly between market makers that are maybe willing to sell that option to you at a better, giving you a better price. And that would be the price improvement auction, right? So sometimes you may enter in a trade and you say, well, I try to buy for $1.10, and wow, I got filled at $1.07. So you saved 3 cents. Well, that could have been because it entered a price improvement auction and there was a market maker or an order there that's hidden, not visible, but willing to negotiate at a better price. So 22% of those trades hit the price improvement auction, which tells us that there's good liquidity there, and there's a good chance that maybe even if you place your order in between the markets or a little bit below or above the markets, that you may be able to get a price improvement, right? So this shows us that there's some good liquidity there, and market makers, specialists are willing to even squeeze in their prices inside what is displayed. Then we got the intermarket sweeps. That's 8%. And these would be the more aggressive orders. So when you have a person who wants to get an immediate fill on an order, and they don't want to go from one exchange to the next exchange to the next exchange, they just want to be able to get their entire fill, they could enter in an intermarket sweep order. And what it's saying is, go and take the top of book on each of these exchanges. Even if I have to go and pay a higher price, let's say, than a different displayed exchange, I want to make sure I hit all those exchanges simultaneously, because if I don't and the stock moves, I'll end up having to pay higher anyway. So that's an intermarket sweep order. It would be more aggressive. You'd have to designate your order as an intermarket sweep order, and 8% of the trades hit that intermarket sweep. And then 1% of the trades happen on the floor. And what this is saying is that instead of entering your order electronically, this order was handled with a physical touch. There's a broker, somebody called a broker on the phone. The broker tried to negotiate perhaps with another market maker or specialist, went and shopped around the order. And the reason for that is that sometimes you could have an order that is very large, and if it's very large, maybe beyond what the liquidity is displayed, then the broker to get it filled all in one at one price, we'll try to go to market makers, go to specialists, maybe go to other traders and ask them if they're willing to trade at this price. And maybe you get like 5 market makers all willing to say, I'll sell 100, sell 100, sell 100, and then you got your 500. And sometimes you'll need a floor broker to do that. Another reason is maybe you're trying to get a better price, and you're trying to figure out by talking with people, well, are you willing to, go down in price if I come up in price, or are you willing to meet me halfway or somewhere along that? So that happens where you need human touch, right? Where you're trying to negotiate either for volume or price, and you need some human touch and relationships to try to get that execution. So 1% of those trades in Nvidia were floor trades. Okay. Then we got this other stat, and this is comparing the trade price versus the state of the market at the time of the trade. So you could see, we got a trade, and then we have this bid and offer at the time of the trade. The bid and the offer are just the displayed interest. That's where somebody's willing to buy an option at a certain price. The offer ask is the price that somebody's willing to sell it, and those are firm. That means once you display it, if somebody hits your bid, you're obligated to buy. If somebody takes out your ask, you're obligated to sell. So it's not something that is, you're suggested. It's firm. Once you say, you enter in an order, I'm going to buy 10 contracts at $1. Well, if somebody hits that bid, you bought it, right? It's not, and the same thing on the offer. Once you put it out there, once you say, I'm willing to sell this option at $2, and if somebody takes it, that's it. You're obligated to trade it. So those bids and offers out there, they're firm. So if we compare where the trade happened versus the bid and offer, we could kind of get an idea of the liquidity and how things were executed. So here we see 27% of the trades happen on the bid, 29% on the ask, and 12% were not on the bid, but they were below the midpoint, so they were closer to the bid. 12% were above the mid, closer to the ask, but not the ask. Then the intermarket sweeps, we could see they could have caused trades that were below the bid or above the ask, 1%, and then right at the mid, 18%. And this gives us an idea how the trades are executed relative to those bids and offers, right? So you can see almost equal amount hit exactly on the bid or the ask. So they had to get executed, they had to take out the offer, hit the bid. 18% happened right in the mid, which shows that there's pretty good liquidity and chance for price improvement, because you have almost 20% of those trades happen right at the midpoint, right in between. So there's a possibility you don't have to reach, right? This gives us the probability of you don't have to reach for the ask or bid, because we see a decent amount traded right on the mid. And you could see that about 12% they traded away from the mid, but didn't have to hit exactly the bid, and the same thing on the ask side. So now we're just trying to build an idea of how these trades are being executed in Nvidia, to get a sense of the liquidity. And even before you entering your order, right, and one of the analysis is, well, how do I improve my execution? Because your execution costs, especially as you do more and more trades, are going to add up and be a big part of your the cost of your trading system. And to improve your execution costs, you want to know how are things in general getting executed on, in this particular stock. Then I'm going to slide down here. We're almost done, but I'm going to just go, we're almost up at 9:30, but I'm just going to go over these notable trades. And the difference here we looked at the most active options. So this includes all the trades cumulative, right? So if we looked at, there could have been one trade or 10 trades or 20 or 100 or 1,000 trades. So this is looking at the most active cumulative. This is looking at just a trade alone, right? So this is just looking at trades. And here we see that these were the top most notable trades in Nvidia. There are 10,000 contracts that traded on the July 19th 138 put for $15. Our interpretation is that the incoming order was a buy. There were 8,300 June 28 123 puts for $2.50. Our interpretation is a sold, and so on. So these are the top 5. Just looking at it, and I'm trying to spot a pattern here. The top 5 were all puts. The strikes were between, the low strike 123, highest 138. So kind of around where the stock was trading. And 2 of them were the expiring options. Then you got the June 28th, July 19th. So the only nothing sticks out that much, but the top 5 were all in the puts. So I'm going to end it right here. We're right up at 9:30, Will, and we'll just continue tomorrow if there are any questions. Okay, I think I lost Will, so I'm going to end it here, everyone, and thanks for joining. Stay safe out there. Have a great trading day, and I hope to see you guys tomorrow.